Morning. Welcome to the Professional Insight Podcast, Season 5, episode We Don't Know. My name's Brandon Curry. Oh, thanks, Rookie. Episode 11. My name's Brandon Curry. Where is everybody else? Oh, there they are. All right, come on.
I'm Jeff.
Josh Bond.
And Trevor Lindy.
We do have a great guest today. He's just in the green room right now, waiting patiently. Back. All right. Frank DiPietro, rookie, bring him in. There he is.
What's going on, Frankie?
Hi, everyone.
Hey, Frank.
Good morning. Good to see you all.
Thanks very much for joining us.
You're welcome.
Afternoon now.
Yeah, it's
Well,
happening
Not
now.
quite.
Yeah.
Not quite.
That's 6 minutes. We got 6 minutes
Tough, Jeff.
to go. We're off for people that I've last night we had a chat that us were at of two Blazers, right? I mean, it was in the real estate industry, Sally McGarr and Margie Spence, McGarr Realty.
It was hilarious. It was awesome.
Flowing, eh, Jeff?
Glad you guys all
Look at Jeff.
Oh,
He's hungover.
Oh, I slept in good. I got at it last night, but I slept in. I'm good.
Yeah.
yeah, you did. You tore it up real good last night.
I used all our tickets up and then some.
Certainly did.
Yeah. You didn't
You
drink
remember-
one of your tickets there, Lindy.
I did. I a couple.
No, I don't think you even had a beer.
Okay, fair enough. Think what you want, just like your whole other
Yeah.
crap.
What other crap?
I'm not going to say because of the whole comments and the thing you keep reposting in our group chat. Just pertaining to hockey.
Oh,
Nope.
Once
Right.
again.
No.
He knows. Closet Leaf fan.
That Hardy is, for sure.
So the reason why we got Frank
But wait,
on
one more comment.
is he is. All right. What's the comment?
Jeff,
What?
What do you say?
do you remember that you forgot that you talked to me earlier in the night?
About what?
No, you just forgot that we had an exchange. I haven't seen you all night. I said, yeah, we talked earlier in the night. You didn't remember.
It's one of those.
Yeah, he was split pretty good.
I got it. I had a good time last night. Let's just say that. Work hard, play hard, boys.
So-
Work hard, play hard.
Absolutely.
The topic of this episode specifically came from one of our viewers who constantly watches the show and comes on and we threw the chat on here on Restream here. And she has we were hello, Leanne. How are you? And she had no idea about and other come with the disability credit. So honest, we covered that because it's a topic and it's extremely impactful. So I decided to bring Frank on from Mackenzie Investments, who we as a firm, our firm, use Mackenzie. And just full disclosure, not a lot of companies take on RDSPs. That's the Registered Disability Savings Plan that you can only get if you have a disability tax credit. Hi, Stone Seawitch. Hello. We were, and she had no idea. So I want to touch on that, Hank, if you want to come on and briefly introduce yourself and at Mackenzie and Mackenzie's role on how they do RDSPs and with a couple of key cases for a couple of clients of mine.
Sure.
There he
Thanks,
is.
Brandon. Thanks. Yep. Here I am. Thanks so much for having me. What a great topic. So many Canadians affected by disability. You know, statistics show those over age 15, 1 in 5 Canadians are dealing with someone with a disability. And I'm part of the tax and estate group at Mackenzie Investments. And back in 2008, when the government officially launched the RDSP, we made a pretty bold decision at the time to really sort of wrap our arms around the RDSP and really make this available to Canadians. No one else was really doing it like us. So anyway, here we are many years later. We're one of the top independent wealth managers in Canada, offering RDSPs to those with disabilities or family who are looking after someone with a disability. We manage over $1 billion in Canadians' money, representing well over 50,000 accounts. So, and more work to do. Like you say, there's still an education gap. A lot of Canadians who still aren't aware of how to fully leverage the RDSP. So we're really proud of where we've come from and where we are today, and we continue in my role to work with financial advisors across Canada, like yourself and the group here, really bringing the RDSP to the market, and not only the product, but the knowledge as well. These aren't simple plans to understand. There's a lot of rules, and the government's always refining the rules and making changes. So part of our role is to stay on top of those changes. We sit in the federal budget every year in lockdown, getting all the tax changes, and that's generally where we see changes to RDSPs, and we're bringing that to the financial advisor market so that Canadians can leverage these things to the fullest extent possible. Governments really set aside a lot of money to help Canadians with disabilities save for their financial future. And that's really, at the end of the day, what we're trying to do in our tax and estate group, and as part of what Mackenzie does overall.
No, and you got such a great, let me see, I believe we had Mackenzie Invest is correct. Yes, that is correct, Leanne. You can. Mackenzie just doesn't they are a massive fund company. However, one of the many fund companies that our firm deal with, however, when it comes to our DSPs, we solely deal with Mackenzie because they do it so well. And you have an entire division. I think the only fund company that I know of, entire division, unlike that, right? That's all you do is our DSP, and it's very a little bit serendipitous. This morning, a lady that actually a couple of us on here know, client of mine, she's 63. She is. Gave me permission to mention her nicely, but she has bipolar 1. So she in a high functioning for being formerly known as manic depressant, and she just qualified for the disability tax credit. So I was pushing her. I'm like, you're going to qualify. You have to qualify. She's like, I've been turned down. I'm like, yeah, but you were turned down like 15 years ago, and the definitions for the disability tax credit have extremely been expanded. So that was such a great phone call to get this morning at 10 o'clock in the morning that literally this is very well potentially can change her life because it was backdated 18.
Nice.
And Frank, you want to take people? Yeah. So Frank, tell people on how they can also go ahead.
I know what an RDSP is. I know what it is. But
that's such a story.
Oh, go ahead. Go ahead,
sorry,
Frank.
I must be glitching out.
Yeah.
Yeah. So just on that note, on that note, Brandon, I mean, that's such a great story. So I guess just for the audience, just an important reminder that in order to set up an RDSP, one of the criteria you require, eligible for the federal disability tax credit, which is a non-refundable tax credit that you claim on your tax. And Brandon, as you're alluding to, this is something that if you have a disability, you need to have your medical professional, doctor, nurse practitioner, complete a government form and submit it to Revenue Canada, and they will approve or disapprove that form. If they approve it, great. You can claim this disability tax credit in your tax return. Great tax savings. But what it does is open up the doors to other things like being able to your own registered disability savings plan. So it's really, really important. What I generally tell people, I'm glad you are persistent, Brandon, on this with this individual, is, you go through, if you go through the process and you're denied, right? Don't end there, right? And in fact, before we even submit the form to Revenue Canada, read it, right? Read the form. How did the doctor fill out the form? Because we've spoken to parents of children with disabilities who they know their children's disability better than the doctors do sometimes. And so if you don't agree with the doctor's assessment of child's disability, then talk to that doctor or get another opinion, or go see a different doctor to fill it out who maybe can better articulate what the disability is. Because from Revenue Canada's perspective, they're going to accept or deny based on what the doctor says the disability is, right? And to your point, things change over the years. Disabilities could progress or they could get better. And so if in 1 year you're denied, but perhaps the condition changes, then reapply, right? So it's important that we are our own self-advocates here and push where we feel we are entitled to something that's not being given to us.
Yeah, you're spot on with that. I mean, you need to people need to understand. So we're gonna tackle a couple things here. We're gonna first tackle, because I know Bondo, you had a question about the RDSP, but and we'll definitely let you ask that question to Frank, because we have options here too. What we've got basically is the disability tax credit application. So answer those. Jovi Fall, was he a goalie? Different Frank DiPietro. Were you a goalie? I mean,
Rick.
I know.
Rick DiPietro.
Yeah.
I wish I got his contract. He's still getting paid, and that's
right.
Yeah.
I know, it's crazy what he signed with us for. That's hilarious. Now then she asked about drugs. So basically, with the disability tax, I think I know what she means by that. It is not whether or not you have a job or you don't have a job. It has income. It has nothing to do with you being physically impaired. You can't work. It is, do you have a disability that otherwise, if it wasn't for medication, otherwise, if it in any capacity, you would be incapacitated, right? So let's use my client's manic depressive. She has manic depression, right? Therefore, she kept getting denied about 15 years ago, but things have been broadened. They've changed, and it got back to 2018, which filed all of her taxes as if she's had disability tax credit since 2018. She'll be right. You're right, Frank. You need to be persistent on this type of stuff, because doctors sometimes look at it from a medical perspective. Is this person physically disabled? Well, that's not what CRA is asking. So, Frank, you want to expand on that's like, idiosyncrasy that between the two professions?
Sure. So do you want me to go into more of like a technical discussion of how to qualify for the tax credit? Would that be helpful?
No, just yeah, that would be helpful. Yeah, like basically talk about why is there, you promoted something along the lines of, um, for example, your own advocate, right? And like I've had children with ADHD, ADD, type 1 diabetes, insulin dependent, all qualify for the disability tax credit. They're fine. They hold jobs. They're totally cool, but they actually have a disability. So you want to talk about that,
Sure.
Frank?
Yeah, sure. I mean, those are good examples of more recent changes to how Revenue Canada deals with those types of disabilities. There's a lot more recognition around mental illness, mental infirmities, and disabilities. And so many of those types of illnesses and disabilities that may not have been approved even 5 years ago, Revenue Canada is more accepting of today. There was even a change, an administrative change a few years ago around type 1 diabetes. So you highlighted that example as well, which is one that now Revenue Canada approves those with type 1 diabetes to be eligible for the disability tax credit. There still needs to be some underlying right that the government looks for when issuing the disability tax credit. So, and this sometimes gets a little bit technical, and I apologize, I don't want to be too technical in any sense, but I think it's important to understand sort of where they're coming from, right? Because disabilities, for example, for ODSP purposes, right, the way they define a disability is different than how Revenue Canada defines it for tax purposes. Or similarly, if you're entitled to the Canada Pension Plan disability benefit, CPP treats disability different than, say, again, Revenue Canada. So the question is, how does Revenue Canada define a disability for purposes of the? So a couple things. First off, they basically say that an individual with an impairment must either have that impairment be prolonged, meaning that it lasts or it's expected to last for at least a 12-month period, and that it's present about 90% of the time, right? So disability's there, you've had it for at least 12 months, and it's prevalent most of the time, or what they call substantially all of the time, which they define as 90%. So that's the general sort of rule. And if you think to yourself, okay, well, you think about your own personal situation, perhaps, or your child's, I think are so good, I qualify. Then a little bit deeper to look at the specific disability. And Revenue Canada is at whether or not the disability markedly restricts your ability to perform at least one basic activity of daily living, right? What's a basic activity of daily living? Well, essentially, feeding yourself, walking, hearing, and as well as a variety of mental functions as well, right? So you need to be markedly restricted from one activity of daily living. Okay, now you have to say, okay, well, what does that mean? What does markedly restricted mean? And again, here I'm sort of paraphrasing what they say, because this is we as tax people need to kind of go with. And what they say is a person is markedly restricted if they are able to, or it takes an inordinate amount of time to one or more of those basic activity living, even with therapy or other assistance. And again, that this must be present substantially all the time, which again, as I mentioned, percent. So it takes so to be markedly restricted, it needs to take an inordinate amount of time. Well, what does that mean, right? Like, what does it mean that if you have trouble walking, what does it mean to walk in an inordinate amount of time? And again, this is where the doctors need to be more involved, and it becomes a bit of a clinical judgment. But what they look for is for the medical practitioner to observe any recognizable differences in the time it takes that individual to perform that activity. And if it takes that individual at 3 times the average person to perform that same function, same age, then they consider it to be markedly restricted, right? So there's this very specific test, and it becomes a doctor's judgment as to whether or not you meet that test. Now, that's a pretty severe measure. And to your and that's, you know, those that are truly limited in perhaps their function and mobility maybe are not able to hold down a job, as an example. But to your point, Brandon, there are others who are you know, can hold a job, function, and still qualify. And that's because Revenue Canada has a different set of rules that say, look, if you're not markedly restricted, you can still be eligible for the disability tax credit if you are what they consider to be significantly restricted. So, you know, a little bit of a more lenient definition than markedly restricted, just significantly restricted. In this case, you'd have to have at least one basic activity of daily living that you're struggling with, right? So there needs to be more than a case, or life-sustaining therapy, or you're blind, right? In those cases, that's sort of the criteria that Revenue Canada set out for qualifying for the disability tax credit. Sorry, it's a bit of a long-winded definition, but I think it's important to highlight that really what it comes down to is that doctor's assessment of your function. And so when they complete those forms, you know, again, as a parent, read it. And do you agree with the doctor's assessment? Because it's ultimately going to determine whether or not you're denied that claim or accepted.
No, and thanks very much for that. I mean, like it is very confusing, and you can understand why. I mean, like one of our watchers right now, which by the way, I need to acknowledge only because we've got Leanne made a great comment. You know, our thoughts and our and prayers are going out to the people down east. You know, I've got a family down in Nova Scotia and also in Newfoundland, Labrador. My one side of my maternal side of the family is all from Nova Scotia, so thoughts and prayers with the hurricane heading your way. So I want to make that a address first and foremost, because that's pretty damn scary. But then Stone Sea, which basically said, wouldn't it make sense to have the same across? Great question, and we're dealing with there's your answer. Nothing is simple and straight line when dealing with government agencies. It is the most frustrating thing. And, you know, my heart goes out to people with disabilities because they're already markedly, you know, at a disadvantage. Off down there. I know you guys are. You guys will be fine, but, you know, we're thinking about you guys. So your heart goes out to these people who I'm not going to qualify, or I'm not disabled, or I'm not this. And it's just like, this is a tax situation. This is not whether or not you can't work. And then now to lead into something else, which is the RDSP, the Disability Savings Plan, which you can only get if you have the disability tax credit. So, Bondo, you had a question for Frank regarding the RDSP.
Yeah, and I am coming through okay. I'm a little glitchy. My technology still can attest to it, so I apologize. Just conceptually on our audience to understand, we've got the 1 year mark that helps you for the retirement, but what is it, and what's the contribution or kind of tax savings that disabled individual will be entitled to?
Okay, yeah. So sorry, I was broke up a little bit there. My understanding is you just kind of want to understand sort of why someone would set up an RDSP and what kind of tax savings would they achieve from it? Is that what I'm understanding here?
Yes, that's pretty much what he. Yeah, that's what he asked.
Okay, yeah.
If there's a percentage or a cap.
Sure. Okay. Yeah. I mean, let's touch on some of these kind of criteria. As I mentioned, there's lots of rules, right? And there's limits and caps and grants and bonds. So at the outset, what you want to think is, people may be more familiar with the Registered Education Savings Plan, right? The RESP, where a parent can contribute to this account. And it's designed for education savings, and the government will match those contributions and put a little bit of money away for the children's education, as a way for the government to support parents helping kids save for post-secondary. And so the RDSP was sort of modeled after that RESP platform, in the sense that one, it's a registered plan. So what that means is it's registered with the government. And just like your RRSP, any money that's in the plan, as long as it stays in there and is earning income and investment earnings, the government won't tax it for as long as it remains inside the RDSP. All right, so it's a tax-deferred vehicle is what we generally refer to them as. And like an RESP, any contributions that go in are not tax deductible. So a parent putting money in for their child's RDSP is not going to give them any sort of tax deduction per se. So it's after-tax money that goes in, but the investment earnings are tax deferred. Kicker to all this is the government matching that's available. The money that the government will set aside and contribute to that child's RDSP relative to an RESP. We saw a comment there from Leanne. We did RESP contributions. It kind of helped. Well, it kind of helped because the matching is okay, right? But with RDSPs, the matching is incredible in my view. So the matching, there's two different incentives that the government will support those with RDSPs. One is called the Canada Disability Savings Grant, right? And the other is the Canada Savings Bond. So the grant itself, it's up to $70,000 over the course of the beneficiary's life, right? And payable to the account up until the end of the year in which they turn 49, right? So for young children, you've got lots of time to kind of make annual contributions to these plans. And that's based on contributions that go in, and it's also based on income, right? So different matching for different income levels. And then there's the bond, because we hear from a lot of parents, struggling parents in particular, that it's great we can open up an RDSP, but we can't afford to make any contributions. And we still say, particularly for low-income Canadians, it still makes sense to open it up. Why? Is because there's an additional bond that the government will pay that is not based on contributions. It's solely based on income alone. So if you meet certain income thresholds, I think for 2022, it's about family income of $50,000. So if you're under that threshold, you can receive up to $1,000 per year, or up to $20,000 for the lifetime of the beneficiary. So we have up to $90,000 in government grants that can go into the RDSP. And to Brandon's point earlier around those who are getting DTC eligible today, but are being retroactively eligible, say in Brandon's client who goes back to 2018, you can, with an RDSP, retroactively, in Brandon's case there, go back to 2018 and start to collect some of the grants and bonds that they may have been entitled to from 2018 on. So very quickly, we see these accounts that start off very nominal, but with regular contributions, grants, and perhaps some bonds, as well as some market performance. I know this year's been a little bit tough, but over the long term performance, these accounts grow quite substantial, and really provide a secure pool of money designed for the retirement of those with abilities.
A fabulous explanation. Thank you.
Yeah, and it's extremely extremely powerful. Other good thing about it is the retroactive and companies like McKenzie, what they do on the back end, what you don't see, because they take your SIN number. It's all the matching is all based on income. So if net income is under around $90,000 a year, you can get up to 300% matching, which is insane. So I've had, in many cases, my clients contribute 35 contributions and get 10,500, the maximum grant money government will give out in 1 year. So you've contributed 35, the government contributes 10,500. Holy crap, that's a 100% return on your money.
It's amazing.
That's insane. And then they keep
That's right.
going back. So
that's why
they'll go.
That's right.
How retroactive?
Yeah. So
years.
I mean, that's why they go back as far as 10 years or to the date of disability, right? So as far back as 10 years. So on top of that, what they'll do is apply all the highest matching grants first, right? So they kind of help you maximize your RDSP as quickly as possible. So just very, very quickly on that, Brandon said a 300% matching. So your RESP, you contribute, and the government will match 20% up to a $500 per year maximum per year, and up to $1,000 in any 1 year or something like that. With an RDSP, to Brandon's point, for 2022, if your family net income is under $100,000, the first $500 contributed attracts a 300% match from the government. 300%. You put 500, government puts in 1,500, and then a 200% matching on the remaining 1,500. Right. So just incredible matching rates. And then even if your family income is higher than 100,000, it's a 1-to-1 matching. So put in $1,000, you get $1,000. So not as generous, but still pretty good. And so those are kind of a little on the it's a little bit on the annual grants. Now you can have this ability to go back up to 10 years and collect retroactive grants. And that's where the government says, well, we'll allow you to go back, but the most we'll pay you, or the most in grants you can collect in any 1 year, is $10,500. Right? So, it gets a little bit tricky because you want to figure out, well, okay, how many need to contribute this year to get that 10.5? That's where you work with a financial advisor. That's where you work with you guys. That's where your value comes. And you work with the clients to help determine, okay, what makes best sense here? How much do we need to contribute to get that max grant? And in some cases, for those who are, eligible for 10 years of retroactive grant, contribution a few $1,000s a year to get 10.5, and you do this for a few years. Right? After 4 or 5 years, we've seen cases where if the family has contributed over the course of 5 years, say, anywhere around 15 to 20,000, but now you got an account that's closing in on 100,000 with grants and bonds and performance and everything else. So these things can accumulate quite quickly, and it's all because of the power of the grants and bonds that you might be eligible for.
No, and that's great. We have a couple questions coming in, which is great. So I'll just quickly just get everyone up to speed. Leanne was saying she was in a car accident in 2015. Sorry to hear that. 2 C-spine surgeries. And so, holy smoke, do we have this for adults? Yes, Leanne. The RDSP is not is you could have the RDSP for your entire life. That's totally fine. But grants and bonds will only go until December 31st in the year you turn 49. And there is a criteria that you need to follow. Is they follow like the LIFO rule, which is last in, first out. There is a clawback. We're not going to go into that here because Frank and I will lose you calculations that the government uses to figure out what the clawback is. But if you take grant money applied at the age of 49 and you take it out at age 55, yeah. So Liam, you could have an RDS, but you would Frank, if she has a if someone has a disability and they're just finding out this for the first time, can they retroactively go back even though she's 50 now? Did he freeze? Oh,
It almost looks like it. At
was a
one
little
point, the
frozen.
eyes were rolled back in his head.
He glitched there a bit.
yeah. Oh, there we go.
I don't know if it's me or you.
Coming.
Oh, you're coming in. Yeah, coming in a bit glitchy. Oh, well. Anyways, I'll find out that answer. But I know you can only contribute, get and get contributions. But if you're on this now, I guess the question is, you practically go back 10 years in hypothetical. Can that know that? I don't know that answer. Oh, Frank, no.
Like
Oh,
Weekend at Bernie's.
So there you are.
Oh.
Yes. Well, we'll figure it out. So okay, well let's keep going. Now there's. We'll just get Chris. No, it's glitchy for whatever reason. All right, yeah, back in. There we go. All right, we'll keep this going. So we'll find out when he gets a better connection. We'll right back on.
So, Brand,
Can
I ask you a question?
Yeah.
So my mom, say right now, she's been disabled since bipolar, I believe, early 40s. She now contribute money and from between the ages of 40 and 49, say.
So we got to find out when Frank comes back in. Oh, there he is. Hey, bud, how are you? Can you hear us okay? Oh, there goes.
She's gone.
This is what happens when you do it live, right? I mean, it is what it is. So
yeah, shit happens.
We don't know what can happen. I have to ask him that question. I believe because we've always been told that it's a hard, fast rule. But if you didn't qualify, like for example, my client, she's 63, so opening up an RDSP for her right now is just pointless. As Frank tells me, I mean, only because her only go back to 2018, right? And so she was still over the age of 49 at that, so it doesn't really matter. But if someone had a disability and they said no, she's had this since 2002, that would then make her 43. What could we open up an RDSP and take advantage of, let's say, maybe 10 years worth of returns to get some grant money? I don't know that answer. That's actually a really good question. But there's another piece to this. All disability tax, you can open up something like a Hensen trust. Now, a lot of people here are wondering why, what's the big deal? Well, if we're talking in the province of Ontario, basically you can qualify for ODSP, or on the Ontario Disability Benefits, right? Right? That Ontario, every province has some.
Help system.
I appreciate that. Anything else, Bondo? You have any other comments?
Good discussion. Good description of it. Thank you.
And by the way, one last point on the Hensen trust. So as part of an estate plan, you know, you might be thinking your kids are DSP. You know, you can do it up, and I'm not sure we touched on that lifetime limit of contributing. So there's a $200,000 limit. Everything over and above 200,000, you can put into an Hensen trust, and that would ODSP benefits, or put all the money in the Hensen trust. And what we often see is that the trust annual contributions to the RDSP from the trust, right? So the RDSP, and that's a great way from an estate planning perspective to the kids and part of your estate plan. So something to think about. Obviously, you know, want to have to meet with the experts here and talk about how to implement all this, but options that are available now that are so critical.
Perfect. Well, I appreciate you taking the time, and I apologize to you had to go through all those tech issues. That kind of sucks, but we really appreciated you coming on. This is just over an hour, so it's a good little episode. I hope people found this to be insightful, at least. And if you have any further questions, you can see down at the bottom. Email us info@professionalinsights.ca, and keep the questions coming. But other than Bondo, if you want to take us out,
Help us, help you. Stay in.
Ciao.
Out.